Good afternoon. Can you all hear me?
Good afternoon, sir.
Yes, ma'am. Can you hear me and see my screen?
Yes, sir.
Right.
Thunder. That is a 50 for this.
Okay. So let us continue from where we stopped in our last class. We are still. Where's Mrs. Angela? She has not joined. She has not joined the class. What happened?
Let me call her.
Okay, please do. Let's just give her a little time for her to join, please. I just called her and she told me she's online.
Hello, sir.
Yeah.
Our phone is switched off.
Yeah, I just called her now.
Okay, did you get her?
Yes.
Okay, okay.
She told me she's in. That is the network. That's what she told me. So let us continue. In our last class, we look at the traditional theory and Miller and Modigliani. We look at Miller and Modigliani preposition what? Preposition 1, 2, and 3. with respect to
Hello, sir. We can't hear you.
You can't hear me, is it general?
I can't hear you.
Mrs. Angela, can you hear me?
No, I can't hear you.
Okay, let me enter again then. Maybe it's the network.
I can't hear you, sir. I don't know if
I'm
other
coming.
people can hear you. But me, I cannot hear you. Maybe I should log out and log in again. Madam Angela too cannot hear you. Or maybe you should log out and log in again, sir.
Can you hear me now? Can you hear me now? Hello? Can you hear me now?
You see?
Can you hear me?
Yes.
Okay, you can hear me. Okay, thank you.
It's fluctuating though, but can hear some.
Oh, yeah, okay, sorry about that. That's the network. So, I said in our last class, we look at the traditional theory of capital structure. We also look at the Miller and Modigliani theory. Look at the Miller and Modigliani theory in 1958 and 1963 in our last class. Now, we have explained the theories. We have explained them. We are to solve questions. We are to solve questions now. But before we solve questions, let me know whether you have some areas of clarification rather, before we continue. Do we have any issue that we need to address before we continue the class? Any issue? Do you have any issue we need to address? No, Abby? Do we have? Okay, there's no issue. Okay, let us continue. Now, let us take example 1. Of course, I'm going to solve just example 1 and 2 for you. The reason is this. Frankly speaking with you, capital structure theory is just application. And of course, before now, we have been applying this theory, where the principle of congearing and regearing is based on Miller and Modigliani. All the formula we use for congearing, regearing, they are based on what? They are based on theory. Okay? They are based on theory. That's why I said I won't waste much of our time. I will just take example 1 and example 2. Then we go and discuss the remaining. We go and do the remaining 2 theories, which is the static trade-off and the pecking order theory, so that we can move to investment appraisal. Okay, in our next class. Now, let's take example 1. Northern PSC and Southern PSC operate in the same industry and are identical in many respects. There should be many respects. They are identical in all respects. After that respect, there should be all. And are identical in all respects, except in their capital structure. So what do you mean by this? It means Northerner and Southerner They are the same, though different companies, but they are similar in terms of characteristics, and except the fact that their capital structures differ. The earnings before interest and tax of each company amounted to 12.5 million. Northern PLC is not levered, but Southern PLC has 40 million, 7% debenture in its capital structure. The equity capitalization rate of the firm is 12%. So look at it. Northern PLC is not levered. That is, Northern is an unject company. But Southern PLC has what? Has 7% debenture. So Southern is jet. So that is the only difference between these two companies. One is having debt, the other one is not what? It's not having debt. Now, the equity capitalization rate, what does that mean? When we say equity capitalization rate, we are simply saying cost of equity. The cost of equity of the two companies is what? Is 12%. Is 12%. We are required to determine and evaluate the implied capitalization rate and the value of the firm using the net income approach. So the question is what? We should determine and evaluate the implied capitalization rate. What do we mean by capitalization rate? Capitalization rate simply means weighted average cost of capital. Okay? It simply means our work. So anytime the question asks you to compute implied capitalization rate, what the question wants you to simply compute is weighted average cost of capital. Okay? Weighted average cost of capital. So that's what I want to compute here. Using what? Using the net income approach. Please don't let this one confuse you. All the cost of capital we have been computing up till now, they are what? They are computed using the net income approach. So it's not a new thing. When they say compute cost of capital using the net income approach, it is the same what cost of capital we have been computing. No difference, please. B, assess and advise an investor. Assess and advise an investor who owns 5% of Southern. Southern is JW. Who owns 5% of Southern PLC share on how he can increase his return through the process of arbitrage, assuming the hypothesis. When we say arbitrage, what do we by arbitrage? Arbitrage means moving from a J company to an unject company. You have your investment in a company that is having debt, okay, in a J company. You have your investment in a J company. You now want to sell your investment in that J company to invest in an unject company. That process of shifting from a J company to an unject company is what we refer to as the arbitrage process. Okay, so we want to see what will be the impact on income of a shareholder who has 5% investment in Southern PLC. How he can increase his return through the process of what? Arbitrage. And the arbitrage is what? Arbitrage is always associated with M hypothesis. M hypothesis states that it is possible to increase your return by moving from a J company to an unject company. Okay? So let us attempt to solve this question. Let us attempt to solve this question. Okay, capital structure theory. Capital structure theory. Okay, the first question there is question 1, example 1. Example 1. There's a Southern and Northerner. PSC. So what's the first requirement? Requirement A is the computation of what? Computation of work of the two companies. Computation of work of the two companies. Now, look at this. Let me check whether my battery is charging. It is. Now, look at this. We have in this question, we are given 12.5 million, Abi, as the what? As the profit before interest and tax. If you want to compute, okay, if you want to compute your work, you already know the formula for work. That your work is what? Work is computed as work equal to cost of equity into bracket market value of equity all over market value of equity plus market value of debt. Abi, plus what? Plus cost of debt into bracket market value of debt all over market value of equity plus market value of debt. These are work formula. So if you look at this question, don't forget that we have two ways of computing cost of equity. I mean, we want to compute cost of equity first. We have two methods. It's either you are using the dividend valuation model or you are using the what? The Gordon's growth model. Isn't it? Now, however, look at this. This question has already given you what? The cost of equity. You can see it here as 12%. This is the cost of equity. The equity capitalization rate is 12%. This is the cost of equity, meaning that I don't need to compute cost of equity again. Okay? So I will only need to have my market value of equity and market value of what? And market value of debt. That's what I will need there. And my cost of debt. Already I have cost of equity because I have equity capitalization rate. Equity capitalization rate is taken as cost of equity. Please take note. So the first thing I have to do here is to go and prepare my income statement. Okay, so I have South Danam. I have Northern. I have South Danam, I have Northern. We have profit before what? Profit before interest and tax. Before interest and tax. The two of them as what? 12,500,000 each. 12,500,000 each. Abi? 12,500,000 is what they have. Now, one of these companies is having debt. Which company? Southerner is having debt. Is it Southerner? Let me go and check. Which of them is having debt? Okay, Southerner. Southerner is having 40 million what? Sorry, Northerner. You coming? Northerner PLC is not yet. Okay. Southerner PLC has 40 million, 7% debenture. So Southerner is here. I have to go and compute what? What will be the cost of, what will be the interest payment? So let's go and compute our interest. Interest is 7% of what? 7% of 20, 7% of 40 million. 7% of 40 million. So, what's our 7% of 40 million? Let's get that. Let's get it. 0.07 times 40 million will give me 2,800,000. So I have my 2,800,000. 2,800,000. So this one is not here. So there's no interest. Now, this one should give me what? Profit before tax. This one will give me profit before tax. This is giving me profit before tax. Excuse me. Let me just move this one. So, our profit before tax will be what? Profit before tax. Profit before tax will be, do you have tax rate in the question? Let me go and check. What's our tax rate? Oh, we are not even given tax, no tax. So no tax. The issue of profit before tax does not even arise. There's nothing like profit because we don't have tax rate in the question. Okay? Okay. So we are not going to use tax because in the question we don't have a tax rate. Okay? There's no tax rate. Just forget about tax. Okay? Let's call this all what? Yeah, I can still call it profit before tax anyway. But that's the profit we are going to call. Let me just call it, earnings. The earnings here will be, let's do this, 12,500,000. 12,500 minus 2,800. That is 9,700. 9,700,000. 9,700,000. 9,700,000. And this one is still the same thing. 12,500,000. 12,500,000. Okay. This is our earnings. This is our earnings after interest. After interest, that's our earnings. Now, if this is my earnings, I want to compute market value of equity. How would I compute it? Market value of equity. Market value of equity. How are we going to get our market value of equity? It's going to be this earnings discounted using what? Using cost of equity. We have earnings. This earnings here is assumed to have been distributed all as dividend. You understand? So this more or less retain earnings because the question is not telling that you have paid dividend, have you? So one of the assumptions of this approach is that all earnings are assumed to be distributed as dividend. Please take note. All these earnings we are seeing here, we are assuming that all the earnings will be distributed as dividend. So if all earnings are distributed as dividend, I can get my market value by what? By discounting my what? By discounting my dividend using cost of equity. So I will simply say 9,700, 9,700,000 divided by 0.12. That will give me 18,833. Okay, 833.33. I just approximated 833. Okay, 833, 333. 833. 333. So this is the market value of equity of Southerner. So I will come to Northerner. For Northerner is 12,000, 12 million divided by what? 0.12. That's 100 million. 100, 1, 2, 3, 1, 2, 3. So 100 million is the market value of equity of Northerner. Now, what is the market value of debt? How do I get that? How do I get my market value of debt? Now let's go to the debt. What type of debt do we have there? You can't just tell us that Northern PSC, sorry, Southern PSC has 40 million, 7% debenture in its capital structure. So we are not told whether it is what? Redeemable or irredeemable. Where you are not told that it is redeemable or irredeemable, you should assume that it is what? It is irredeemable. Because there's no way you can what? You can compute your IRR from this information. So just assume that the debt is an irredeemable debt. So if it is irredeemable debt, how do we compute the market value? You discount the interest to perpetuity. Okay? You just pick the interest in. So market value of debt.
Excuse me, sir.
Yeah.
You did 12 million over 0.212 instead of 500.
Instead of
You did 12 million over 0.12 instead of 12,500,000.
Oh, okay. Thank you. 12,500,000, have you? Yeah, 0.12. That should be 104,167. Thank you. 104,167. 667. 667. Thank you.
Okay.
Thank you. Now, we want to get market value of debt. And because we are assuming that the debt is irredeemable, I will simply discount my what? I will discount my interest, which is 2,800,000. I will discount it using cost of debt. What's our cost of debt? You see that here, this is the only information I have. I only have information of 7% debenture. I don't have information as the market value or even spread. So I'm going to assume that the interest rate here is the same thing as the cost of debt. I will assume that the interest rate here is the same thing as the cost of debt. So what will I do? I will go and discount this one using 2.07. That will be my market value of debt. 2,800,000 divided by 0.07. That is 40 million. 40 million. Okay? That's 40 million. 40 million. Now, the next one now is I'll go and get my cost of debt. Let me put it there in case. My cost of debt, net of tax. Net of what? Net of tax. Will now be equal to 7%. Okay, we don't even have tax rate, have we? We don't have tax rate, so it's just going to be the gross. It's going to be the gross because we don't have tax rate. It's going to be 7%. So I cannot complete my work. Okay, let me put it down. Cost of equity in case. Cost of equity. Cost of equity is 12%, 12%. 12% here and 12% here as well. 12% here as well. Okay, 12% here as well. I cannot complete my work. So my work will be equal to, for Southern, my work for Southern. For Southern, work will be equal to cost of equity 12% multiplied by market value of equity. Market value of equity is 18,833,333. 18,833,333. Okay, divided by Market value of equity plus market value of debt will be 120 million. This plus this. That is this one plus this one. Will give us what? Will give us 120 million. 120 million. 833,333. Close it. Plus, what's our cost of debt? Cost of debt is 7%. 7% into bracket. Market value of debt, 14 million. 14 million. So divided by 128,333. So this will give me my work for Taiwo. Work, sorry, for Southern. Work will be equal to 12 times 8233. 8233. Sorry. 12 times 88,333 divided by 128,333. That's 8.8% approximately. You can say 8% plus this one is 7 times 40,000, 40 million divided by 128,333. We have what? 0.23. So add these two together, 0.23%. Add this together, what's our work? Our work will be 8 plus what? 2.2, which is 10.3%. 10.2, no, 8.23 rather. 8.23%. That is our work for who? For Southern. What about for Northern? For Northern, the work of Northern will be equal to what? Will be equal to 12%, because Northern is not jailed. For a company that is not jailed, the cost of equity is set as what? As the weighted average cost of capital. So that is the first approach to this question. That is the solution to the first question. Any question on this?
Yes, please.
Yeah, oh yeah.
Excuse me, sir.
I can hear
Excuse
you.
me, sir.
I can hear you. I can hear
This
you.
work for, you said something about Northerners work equals to 12%. I didn't get what your reason was for it being 12%.
If you follow this lecture very well, let me go back to that place. Let's go back. If you follow this diagram, what did I say when I was explaining this diagram? I said a company that is not having debt. When a company is not having debt, sorry, I want to pick something to illustrate this one. Very good. Now, when a company is not having debt, look at it. A company that is not having debt, the journey will be here. This will be where my journey is. 12 us, journey will be 0, right? And where journey is 0, trace it up. What do you have? When you trace it up, this is my cost of equity here. See my cost of equity. That is the one up there. And see my work. See my work here. Both the work and cost of equity intersect at this point up here. They intersect up here. Okay? Cost of equity and work, they are the same here, because cost of equity came here, then work also come to that same point. So it means that for a company that is not having debt, the cost of equity of the company is the same thing as weighted average cost of capital. Did you understand that?
Okay. Yes.
So that's the reason. Any other question? Any other question? Mrs. Shehu? Any question?
No question, sir.
Okay. Mrs. Shehu, you have question? Ah, she's awful. Okay, let's go to requirement 2. Requirement B. Assess and advise an investor who owns 5% of Southern PLC share on how he can increase his return through the process of what? Arbitrage, assuming the MM hypothesis. Now, let's go and tackle this. That is B. B. Computation of additional profits or additional income as a result of arbitrage. As a result of arbitrage. Now, how does arbitrage work? Look at this company presently. You know the investor has 5%, Abby? The investor has 5% of the equity of Southern. The investor wants to move from Southern to what? To Northern. The investor wants to move from here to what? To here. Now, the first thing you need to go and compute is, this is the market value of the company's equity, Abby? And since the investor has a claim of 5% of that equity, I will go and compute the current holdings, the current holding of the what do you call it, of the investor. Then I will also compute the current profit of the investor, because if I'm having 5% holding in this company, I'm entitled to what? 5% of the profit, and also my own share of the capital is also 5% of the capital. So this is what we are going to do. This is what we are going to do. Current income. Current income. Sorry. Current income of the investor. Current income of the investor will be equal to 5%. 5% times, yes. What is the income? 9,700,000. So multiply this by 9,700,000. That should give us what? 0.05 times 9,700,000. 9,700,000 will give us what? Will give us 485,000. That's the current income. That's the current income. When the company is in what? When the investor is in Southern, that's the current income. Now, what is what? Current investment. Current investment in Southern. Current investment in Southern is going to be 5% of the total value of equity. 5% of 5%. What is the total value of equity? What is the total value of equity? The total value of equity is 80,833,333. So that's his own share of the equity of the company. So what would that give us? What would this give? This will be equal to 0.05 times 80,833,333. So we have what? 4,042,000. 4,042,000. 4,041,000. 667. 67. Now, This is the current situation of the investor. Currently, in Southern, the investor's income is 485,000. While his investment is in Southern is 4,041,667. Now, what happens if this man is to move to what? To Northern, okay? Let me put it as when moving to what? When moving to Northern. When moving to Northern, what happens? If this investor is moving to Northern, number one is that the investor will invest this amount here, this amount of capital here. One minute, please. Okay, sorry about the break. Let's continue. Northern. What's it when moving to Northern? Number one thing is that if this investor is moving to Northern, it means the investor is moving his investment from where? From Southern to Northern. Abi? We have to what? Move this investment to Northern. So we go and recognize that investment. Recognize it. Now we have equity investment. Or let me take it as a investment in Southern. Investment in Southern. That's the one we are moving, Abi. Investment in Southern. The one we are moving there is 4 million. 4 million 041 667. That's the one we are moving. Now, this is an important point you need to note. Anytime a company is an investor, anytime an investor is moving from a J company to an non-J company, because the J company is having debt, that's why it is J company. Now, you have to recognize that this market value of equity should also be J. So what we are going to do, this investor here must also borrow. Please take note, let me repeat it again. You know this one is equity, Abi? This equity investment that this investor has in Southern and is moving it to what? Is moving it to Southern, is moving it to Northern. Now, in addition to this, because the company from where the investor is coming from is a GA company, the company where it's coming from is GA. Therefore, the personal investment of this investor must also be a GA what? Investment. So how do we compute the GA investment? This is just equity. So we must have a word, what we call personal borrowing. The investor must borrow personally. The personal borrowing is going to be 5%. Okay? It's going to be 5% of the borrowing of the company it is coming from. The borrowing of the company where it is coming from is what? Is 40 million. So we also have to borrow what? 5%. That is his holding. This percentage holding here. Percentage holding here. 5% of that 40 million. You also have to borrow it. I think I've explained that reason now. If you are confused, let me know so that I can explain it again. Do you know the reason why I'm comparing that 5%? 0.05 times 40 million. You said? Hello, I can hear you.
No, please repeat it again.
Okay. Then you got this, Abi? You know this?
Yes. Yes.
Now, what I'm saying is that this investor is coming from where? The investor is coming from Southern Abbey. And you know that Southern is geared, right? Because Southern is geared, this investor is coming from a geared company. Now, the personal investment of the investor must also be geared. Okay? It must be a geared investment. Meaning that whatever the debt of the company where this investor is coming from, this debt here, we have to recognize 5% of it. 5% is ordinary. 5% is what is holding. So he must also borrow personal borrowing, to make sure that his investment is also geared. Because the company where it's coming from is geared. His investment, even though the company where he is going into is not geared, but his own personal investment must be a geared investment. And how do we make it a geared investment? We make it a geared investment by recognizing personal borrowing for the investor. The personal borrowing is percentage holding multiplied by the debt of company where he is coming from. So that's how we computed at 5% of what? 4 million. So when you do this, the total investment in Northerner will now be what? What will be the total investment in Northerner? Total investment in Northerner. Total investment in Northerner will now be what? Will be 6 million. Will be 6 million 041 667. This is his total investment in what? In Northerner. That's what he will invest in Northerner. Now, if he invests this amount in Northerner, what is the percentage he will be holding? He will use the whole of this one, the whole of this amount you are seeing here. The whole of this amount is what he will use to buy the equity. He will use to purchase part of the equity of Northerner. Okay, that's what I call investment. He will use this 6,041,667 to buy the equity, to buy the shares of Northerner. Now, if he buys this share of Northerner, what will be his percentage holding? We have to conclude that. Now, percentage holdings in Northerner. Percentage holding in Northerner. Percentage holding in Northerner is going to be the total investment he has in Northerner, which is 6,041,067, divided by the total market value of Northerner's equity. What is it? Northerner's equity is this. I mean, this Northerner's equity. So you copy it. This is the total equity of Northerner by market value. This is it. So out of 104 million, he is having what? 6,041,000. So you now multiply by what percentage? What is the percentage holding? Times 100. So let's get the percentage. The percentage holding is 6,041,667 all over 104, 167, 667 times 100. So he is holding 5.8%. 5.8%. So his investment in Northerner is 5.8%. That is his investment in Northerner, 5.8%. So if he is holding 5.8%, if he is holding 5.8%, what will be his income? That's the next thing. What will be his income in Northerner now? Now, income in Northerner. When you invest in the company, what do you expect? You expect income now, Abby? You expect income. If I'm having 5.8% investment in your company, then it means out of your profit, you should pay me what? You should pay me 5.8% of your profit. So what is that profit? That profit is what we call a return. So what is the income? Income from investment in Northerner. Income from investment in Northerner will now be equal to 5.8% 5.8% of the profit of Northerner. What's the profit of Northerner? Profit of Northerner is 12,500,000. 12,500,000 is the profit of Northerner. So multiply that 5.8%, that 5.8% by what? By 12,500,000. 12,500,000. We have the income to be equal to what? Let me just do it here. The income will be what? 0.058 times 12,500,000. That is what? 725,000. So he'll be having 725,000. What was he having before? He was having when he was in Southern, his income was 485. Now his income is what? 725. Let us go and calculate the increase in what? Increase in income. That's what we are going to. Increase in income. Increase in income. How do we compute that? We can compute. So you compare income in Northerner. That's what we just computed now. Income in Northerner, which is what? Which is 725,000. 725,000 less income in Southerner. Less income in what? In Southerner. What is the income in Southerner? Income in Southerner is what did we compute before? 425, have you? Yes, 485. 485,000. Income in Southerner was 485,000. 485,000. 485,000. 485,000. Now, what is
So
the
where is this
increase?
one? 715. Where is it from?
725. 725. So 485,000. Now we now say, what is the increase? What is the increase? Increase in income. Increase in income. Increase in income will be what? Will be 725 minus 485. What do we have there? 725 minus 485. 725 minus 485. 725, 485. That is what? 240, I mean? 240,000. 240,000. Now, don't forget that this is not the net increase because he borrowed. Did he not borrow? He borrowed. He borrowed 2 million. And what is the interest rate on what he borrowed? The interest rate is 7%. Okay? The interest rate is 7%. So he has to pay interest on his borrowing. The borrowing is his own personal borrowing. It's not that of the Northern. Okay? So he has to pay interest at 7% of what? Of that 2 million naira that he borrowed. So we have to what? We have to reduce the increase in income by that amount. So interest on borrowing. Interest on borrowing. Interest on borrowing will be equal to 7% times 2 million. Times 2 million. Let me just write 20. So what's 7% of 2 million? 0.07 times 2, 1, 2, 3, 1, 2, 3. Times 2 million. That's a 140,000. So this one minus 140,000. This one minus 140,000. Reduce that income by this. So we have what? We have net increase in income. This is the net increase in what? In income. Net increase in income. So the increase in income is what? 100,000. So we can now advise the investor that it is profitable to move from Southerner to what? To Northerner, because doing so will increase his income by what? By 100,000 naira. Is it complex? It's not now. It's straightforward, right? Mrs. Angela. Any question here?
Sir.
This is what we call arbitrage
Yes,
gain.
so because I'm just thinking, if one is first in exam,
This is what we call what?
what is the meaning of this arbitrage? Arbitrage.
Arbitrage means moving from a geared company to an ungeared company. You are switching your investment from a company that is geared, that is having debt. You are switching to another company that is not having debt. That is what we call arbitrage. So the gain you make on that movement is called arbitrage gain. Okay? Arbitrage what? Arbitrage gain. That is called arbitrage gain.
Okay.
Are you fine? Mrs. Shehu, Mrs. Chiwe, any issue here?
Nisi,
Yeah. I can hear you perfectly. He doesn't know your origin. Do you know your origin? You know him. He doesn't know him. He doesn't know him.
but faced with this type of question in the exam, does it have
Sir?
step-by-step approach?
What do you say? I didn't hear your question. No. Mrs. Angela.
I said, if one is faced with this type of question in an examination, does it
What
have a
is
step-by-step approach?
That is
I'm
step
just
by step.
asking.
Look at it. What I've done here is step by step now. What do we first do? The first thing we computer is what? Number one is compute his current income. This is his current income. You understand? Compute his current income. That's step one. Number two, compute his current investment in South Ghana. Current investment in South Ghana. That's the second approach there. Then after that, compute his new investment in what? In North Ghana. That's what we did there. That's step three. Are you following me?
Yes.
That's step three. Then step four, compute his percentage holding in North Ghana. The company is moving towards his percentage holding there. Then compute his what? New income in North Ghana. That's step 6. Then go and compute the increase in income. That's step 7. So I followed step by step, only that I did not label it as step 1, step 2. You do understand?
Okay.
Are you okay, ma'am?
Yes, sir.
So you can label it as 1, 2, 3, 4, 5, 6, 7.
Okay.
Any other question, please? Okay, Mrs. Shem, are you fine? Sorry, my colleagues are disturbing me here. That's why I'm at the teacher now. I'm at FCA. So they're just disturbing me. Are we fine? Shall we continue?
I'm fine, sir.
All right, thank you. What about my able Mrs. Chiwe? Are you also fine? One day I will collect this your iPhone, Mrs. Chiwe. I will collect this your iPhone one day because you always show me iPhone. Is it the latest iPhone? Is it iPhone 11 or iPhone 11 Plus? Mrs. Chiwe is not with us today. Okay, no problem. Maybe we are still in the church. Let us continue. Let us continue. We have solved question 1. Please, let me save this before I forget. So that I can forget that I just close my system. Let me save it. You know, I will always share it with you. So let me just quickly save it now before it is late. So capital structure to yeah. You are fine, Abby. You are fine. So I can continue saving it automatically. So let us go to the next one, which is the question 2. I told you these are the 2 questions I'm going to solve with you. Have you concluded on that question? I said the investor should switch, Abby, because doing so will increase his what? His income by 100,000. Please, you have to conclude though. The investor should what? The investors should switch from southerner to northerner in order to earn additional income of 100,000 naira. Additional income of 100,000 naira. So, question 2. Question 2. APSC and CPSC. Do I even need to do this example? Please, I'm not going to solve that question 2. Just forget about that question. That question is not. Let's solve 3. 3 is still more likely than that 2. Okay? Let me solve because the 3 is much more likely in the exam than what that 2 is. Forget about that question 2. That is not what we should consider. So let's solve 3 instead. Because this 3, you have to understand how to compute theoretical X right price. That's the reason why I want to solve that with you. Okay. Let's look at the requirement of this question. Calculate 1. Labalaba PSC's gearing ratio using both the book value and the market value. 2. Discuss with reference to the applicable theories why Labalaba PSC board might have concern over the level of gearing and its impact on Labalaba PSC's market capitalization. B. Assuming that 149 right issue, assuming that the 149 right issue goes ahead, calculate the theoretical X right price of Labalaba PSC's ordinary shares and the value of a right. And C. Discuss the director's view that the right issue will cause the share price and the EPS to fall by an excessive amount to the detriment of shareholders. Your discussion should be supported by relevant calculation. Can you see the reason why I decided to pick question 3 instead of question 2? So question 3 is much more likely examination question than what? Than question 2. That question 2 is just by the way, just for illustrative purpose. So let's go and solve this. Labalaba PSC. Example 3. Labalaba PSC. So the first requirement A, is what? Requirement A says we should compute A number figure 1. We should calculate Labalaba PSC gearing ratio using what? The book value and the market value approach. You already know how to compute gearing, Abi? Number figure 1. Computation of gearing using both the book value and market value approach. Now, how do we compute our gearing? We can compute our gearing using 2 formulas. I can have my gearing to be equal to long-term debt, let me give you the complete formula. Long-term debt plus preference share capital all over equity plus long-term debt, long-term debt plus preference share capital. This one I gave here is just the comprehensive what? Formula for computing gearing. Normally, your preference share capital is considered as part of what? Long-term debt. So what you will see is this. You can see gearing is equal to long-term debt all over long-term debt plus equity. The formula means the same thing because in any question where you have preference share should be regarded as what? As long-term debt. So you include it as part of the gearing computation. Are we together? This is one way of computing gearing. We can also say that our gearing is equal to long-term debt all over what? All over equity. This is the second way of computing your gearing. Long-term debt over equity. So these are the two ways you can compute your gearing. Now the question says we should compute the gearing based on two criteria, using book value, and using what? And using market value. And using market value. So these are the two ways we want to compute our gearing. Now, let us start with equity in the question. Equity. What is our equity for this company? Let's go back. Our equity is 20. No, don't see me. Okay, our ordinary share is what? 135 million. That is the book value. Abi? If you want to get the market value, it is 135 million over 0.5 over 0.20 times what? Market value, which is 5.2. Okay, so let's go and do that. Book value is 135 and market value is 135 all over 0.5 over 0.5 over 0.5 times what? What is the market value? The market value is 5.2 times 5.2. So let us get the market value there. I believe you understand what I'm doing there. Abi? So 135 divided by 0.5 times 5.2 will give me 1404. 1404. This is the book value. This is the market value. Okay? This is the book value. This is the market value. Now, we have 7% preference share capital of £1 each. The book value is 120. The market value is going to be 120 over 1 times what? 2.88. Let's go and do that. So, preference shares is 120. Then, for the market value is 120 divided by 1 times 2.88. And that gives us what? 120 times 2.88 will give us 345.6. Am I correct? Let me go and check. Did I put the right figure? Yes. And for the debenture, the book value is 90. The market value is 90 over 100 times 85. Okay? So 90 debentures, book value is 90, and the market value is 90 divided by 100 times what? Times 85. And that will give us what? 90 divided by 100 times 85. 76.5. 76.5. So this will not be our total assets. These are total assets. So let's total it. 76.5 plus 345.6 plus 1404. That is 1826.1. 1826.1. 1826.1. 1826.1. Okay, let me do this one first. 135 plus 120 plus 90. That's 345. 345. This is 345. Sure. And this is what? What you computed before? 76.5.
186.1.
1404. 1826.1. 1826.1. That's the market value. That's the total asset by market value. This is total asset by book value. This is total asset by market value. Okay? Total asset by book value. This is total asset by market value. So we have two sets of figures there. Now, let us now go and compute our gearing. You can use any method because the examiner did not give you any method. So here I'm going to use debt over equity. So gearing is equal to what? Debt over equity. Debt over equity. So if it is debt over equity, that's 100. If it is debt over equity, our total debt is what? Is 120 plus 90. 120 plus 90 is what? Is 210. So 210 over 135. 210 divided by 135 times 100. 155%. 155%. Our debt is 1.5. Our gearing is 155%.
Sir, come again, sir.
Our total debt is the sum of preference shares, which is what? 120 plus what? 90 debenture. That gave us what? 210. And we want to measure our gearing as what? Debt over equity. Our equity is what? 135. So it's going to be 210 divided by 135 times 100. 155.5%. 155.5. Did you understand?
I understand, sir.
Now, if I want to use the market value, our preference share is 345.6, and our debt is what? 76.5. Total is 422.1 over market value of equity, 1404 times 100. Our gearing will be 30.1%. 30.1%. That's our gearing. So this is the gearing based on what? Based on book value and on market value. Based on book value and market value. Is this clear? Please spare me just 1 minute. I need to take some. 1 minute, please. What are these? So, any question on this before we continue? Or are we fine? Perfectly okay? Perfectly fine? Okay. Requirement B. Requirement B. Requirement B. So the requirement B says we should do what? Oh no, we are not done with this one. Discuss with relevance, with reference to what? Applicable theories, Abi. Why Labalaba's board might have concern over the level of gearing and its impact on Labalaba PLC's market capitalization rate. Okay. Now, basically, what we are going to discuss is we are discussing the, what do you call it? All the theories that we have discussed so far, which is what? Traditional, M and M 1958, M and M 1963. Okay? Now, the only thing you not comment, I don't want to write down those code again because you already know, have them in your note. Now, you now say where the board may have concern, where will the board have concern about the word gearing, and what is going to be the impact on what? On the market capitalization. On the market capitalization. Now, if you look at what we have done here, when we look at the book value, the what do you call it? The gearing based on book value is what? Is 155.5%. Is that not too high? Answer. Is that not high?
It's high, sir.
It's high. Now, if the gearing is high, if Labalaba PLC want to obtain finance, it will have to obtain finance at a higher what? At a higher interest rate. If you want to get their finance, it will be at a higher interest rate. And don't forget that the traditional theory says that if you are highly geared, for you to borrow, you borrow at a higher what? At a higher rate. And at that moment, your cost of debt will be going up. And if your cost of debt is going up, and your cost of equity is also going up, what will happen to your work? Your work will also be going up. That is the concern that the directors are having. That we are already there, 155.5 is too much. So if care is not taken, our work will start to increase. Because cost of debt will also increase. Because for us to get additional debt, we have to take debt at additional what? At additional rate, at a higher rate. Do you understand? That is the concern. However, is it really a concern? If you ask me, it is not a concern. Do you know the reason? When we are computing work for investment appraisal, okay, we want to compute work in order to obtain your capitalization. I'm not talking about financial reporting journey. This journey you are seeing here is based on financial reporting approach, financial accounting. It's financial accounting journey. Now, when we are computing our work, our journey should be based on what? Our journey should be based on market value. Journey should always be based on market value. So this is our market value of equity. This is market value of debt. And you can see that at that point, what is our gearing? Our gearing is just 30.1%. So we are not there. If you look at it, we are not there because our gearing is 30.1%. So ordinarily, it should not be a concern to the director. For the director to express concern over the gearing of this company, they are basing their judgment on what? On book value gearing rather than what? On market value gearing. Do you understand this? Mrs. Daniela has gone again. So are we fine? Are we fine with this? I don't want to expose you. Just put it down in your own language, please. I beg you. Not to write this. So B, we correct B. Assuming that the 149 right issue goes ahead. Assuming that the 149 right issue goes ahead. Calculate the theoretical X right price of Labalaba PSC's ordinary shares and the value of a right. Assuming that the 149 right issue goes ahead, calculate the theoretical X right price of Labalaba PSC's ordinary shares and the value of a right.
Excuse me, sir.
Okay. Yeah.
Sorry, sir.
I can hear you.
So this last one you were saying, that the market value, that the gearing, so what are we supposed to write? Is it that since the gearing with the market value is
The
low?
first thing we tell the examiner is that with relevant to traditional theory, are you there? Okay,
Yes,
let me just dictate it so that you write it on your own. Let me dictate it to you. Write it in your notes.
okay, sir.
With respect to traditional theory of capital structure, are you writing?
Yes, sir.
At a higher level of gearing, the company will be able to borrow only at an increased amount of interest. Only at an increased what? Sorry, rate of interest, not amount. Only at increased rate of interest. Full stop. Hence, cost of equity will increase and cost of debt will also increase. And cost of debt will also increase. When cost of equity is increasing and cost of debt is increasing, the weighted average cost of capital will also increase. Therefore, the capitalization rate, or we can call it the overall capitalization rate of
Sir. From
yes,
when cost of equity increases, cost of
and
debt.
cost of equity also increase, weighted average cost of capital will also increase. Why? You don't get it, Abby?
I've gotten it.
Okay. Hence, the overall capitalization rate the overall capitalization rate, the overall capitalization rate, the overall capitalization rate, the overall capitalization rate of the overall capitalization rate of Labalaba PSC will increase. And this will lead, and this will lead to a reduction in market value of the company. This will lead to a reduction in the market value of the company. As can be seen, first of all, as it can be seen from the book value gearing, that the gearing ratio is 155%, 155.5%. The gearing ratio is 155.5%. Full stop. Hence, the concern of the directors. 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 Full stop. However, the director's judgment of the gearing level is based on market value. It's based on book value. It's based on book value.
Judgment of what?
The judgment of the director on the gearing ratio.
You're not writing this thing.
He said, what do you say?
You're not writing it on the screen. You see, you're dictating. You're not writing it on the screen.
Yes, I'm dictating it.
I can't see it on the screen. I didn't get the beginning because
sorry. Because of time. If I want to type it, it waste our time. It will waste our time. I want to type it.
Okay,
maybe when you get
from the beginning.
You understand? Mrs. Angela, maybe you get the video, you read part. Because of time, it will wait out. I want to start typing it. Sorry about that, please. So, I said the judgment of the directors is based on what? Book value gearing, Abi. However, judging from the market value gearing, the company's gearing level is just 30.1%, or the company's gearing ratio is just 30.1%. Okay? And this is not something to worry about. Because the gearing is what? The gearing is low. So it is not something to worry about at all. So that's that. So the next one, requirement B. We will have to what? Assuming that the 149 right issue goes ahead. Calculate the theoretical extract price of Labalaba PSC, ordinary shares, and the value of a right. Let's read the question. Labalaba PLC is a large engineering company. Its ordinary shares are quoted on the stock exchange. Labalaba PLC's board is concerned that the company's gearing level is too high and that this is having a detrimental impact on its market capitalization. As a result, the board is considering a restructuring of Labalaba PLC's long-term fund, details of which are shown here as at 31st August 2020. We have total par value and what? We have the market value. Ordinary shares, 7%, 4% redeemable debenture. The debenture are redeemable in 2025. Labalaba PLC's earnings for the year to 31st August 2020 were 64.8 million and are expected to remain at this level for the foreseeable future. Retained earnings as at 31st August 2020 was 146.4. Now, the board is considering a 1-for-9 right issue of ordinary shares, and this additional funding will be used to redeem 60% of Labalaba's redeemable debenture at par. Now look at the situation. When we say right issue, a right issue is a method of raising equity capital where the existing shareholders are given the what? Are given the right to buy more shares of the company in proportion to the what? To the current number of shares they are having at a what? At a discounted price. For instance, if you are a shareholder in a company, your company can call you that, come with Mrs. Angela. You have 5 shares in this company. So you have the right to buy additional 2 shares. Instead of you to pay 5 naira per share, we are selling to you at 3 naira per share. That is a right. So the shares will be sold to the existing shareholders at a price that is below the current price. That is below the current share price. Okay. That is what we call right issue. And the right issue this company is considering is a right issue where if you have 9 shares, you are entitled to buy what? 1 additional share. For every 9 shares you are having, you are entitled to buy 1 new share. That is the right. And we're told that any fund that will generate from the right issue, we are going to use it to redeem 60% of the redeemable debt. That's that. Any amount we realize from the right issue, we will use that same amount to redeem 60% of the what? Of the debenture. Don't forget that the concern of the director is that the gearing is too high, so they want to reduce the gearing. When you pay off some part of your debt obligation, your gearing will improve. Your gearing will improve. So that's what I say here. Okay. Now, however, some of Labalaba PLC directors are concerned that this issue of extra share will cause the company's ordinary share price and its earnings per share to fall by an excessive amount to the detriment of the shareholders. Now, don't forget that whenever you are making a right issue, you are issuing the what? You are issuing a new share. You are issuing some new shares. I mean, you will issue shares and collect money. Now, if it happens that the amount of shares you issue, of course, it will even happen because there is no relationship between earnings and right issue of shares. Okay, there is no relationship. Your earnings will remain the same. but number of shares will increase. So if your earnings remain the same and your number of shares increases, what happens to your earnings per share? Earnings per share will drop. Your earnings per share will what? Will drop. Your earnings per share will drop. That is the reason why the directors are concerned that, oh, this right issue that we want to make is going to reduce earnings per share by an excessive amount. Accordingly, they argue that the right issue should be designed in such a way that the EPS is not diluted by more than 5%. So they don't want more than 5% dilution of EPS. Now, the directors, sorry, this is wish, or not which. Wish, not which. The directors wish to assume that the income tax rate will be 26% for the foreseeable future, and the tax will be payable in the same year as the cash flows which give rise to them. As the cash flows which give rise to them required. We're now asked to what? Assuming that the 149 right issue goes ahead, calculate the theoretical X right price of Labalaba PSC's ordinary shares and the value of a right. So let's see. Computation of theoretical X right price and the value of a right. Theoretical X right price and the value of a right. If you want to compute theoretical X right price, this is what I'm going to do. Number one, what is the existing number of shares? Existing number of what? Number of shares. What's our number of shares presently? Our number of shares presently is total market value, total book value of shares. As we are given in the question, I think it's 135, right? If I'm not mistaken. We have it as 135 over what? Over 50 kobo. So we have 135. We have 135 divided by 0.5. Okay? So that will give us what? 270. Is it million or thousand, please? I'm working in million, in thousand, or in thousand? In million, please. We are working in million. Let me put it in million, please. We are working in million. So this will be 270 million. Okay? 270 million shares. That is our existing number of shares. Now, we want to issue additional shares. Right issue. We want to make a right issue. And the ratio is what? The what? Number of right issue share. Right issue share. You need to know that. Number of right issue share is going to be 1 out of 9. That's the ratio. 1 out of 9. If you have 9 shares, you are entitled to what? You are entitled to 1 additional share. So 1 out of 9 multiplied by 270 million. 1 out of 9 times 270 million will give us what? 1 over 9, I think it should be 30,000. 30, yeah. It should be 30,000. 1 divided by 9 times 270 is 30, yeah. So the new shares, the new right issue shares is 30 million what? 30 million shares. We are having 270 million before. Now, we want to issue a right share of what? Of 30 million. So, total number of shares after the right. Total number of shares after the right. After the right is what? Is 270 plus 30. 270 plus 30 is what? 300 million. 300 million. 300 million. I believe you can see the link. The first one is what? The number of shares that we are having before we issue the right share. The second one is what? Number of right issue shares that we made. The next one is what? Total number of shares after the right issue. Okay? After the right what? Issue. Total number of shares after the right issue, which is 30 million. Now, this is what I will now do. This is what I will do. Okay, we are not done yet. Now, you know that I said for right issue, you are issuing the right shares at what? At a discounted price, Abi. So what is the right price? You must know the right price. The question did not give us the right price, but they've given us an information that will enable us to calculate the right price. That is, the shareholder that want to buy these 30 million shares, what are they going to be paying per share? What are they going to be paying per share? That is what we call the right price. So how do we compute the right price? This is not the standard formula. It depends on how the question wants you to compute it. The question will let you know. So right price. Now, for the right price, what do we want to use the money for? We want to use whatever we realize from the sales of these 30 million shares. I mean, whatever we realize from the sales of these 30 million shares, we want to use it to redeem what? We want to use it to redeem 60%. We want to use it to redeem 60% of what? Of the redeemable debenture. It therefore means that the amount that we should what? We should realize from the right issue should be 60% of what? Of the debenture. Because we want to use the money to settle what? 60% of the debenture. It means that our target is to realize 60% of the debenture from the sales of the right share. So what's the value of the debenture? I think it's 90, right? 90. So our right price is going to be computed as 60% times 90 million all over 30 million. 60% of 90 million over 30 million. That will be what? Look at it too. 0.6 times 90 divided by 30. So 1.8. 1.8 per share. It should be 1.8 per share. Meaning that we have to sell these 30 million shares. This 30 million right issue, we have to sell it at 1.8 in order to get the 60% that we need to redeem the part of this debt. Okay? So that is how we will get our right price in this question. Now, what do we now do? Do we multiply? Yeah.
Please, can you repeat how we calculated this right issue?
How I calculated?
The right issue, sir.
This one, Abi?
Yes, sir.
I use the ratio given. Look at the ratio. The ratio is what? 1 to 9.
Okay. Okay. 1:9. Okay.
1 ratio
1
9.
for 9. Okay.
1 for 9.
Okay.
You understand?
Yes, sir.
So let us continue.
No, sir. No, sir, it's not that one. This one now we just finished. The right price
This one.
is 1.8. Yes, sir.
I said it now. Now, the question tells you that whatever money we get from the right issue, what do we want to use it for? The money from the right issue, what do we want to use it for? Oh yeah, now. You are not asking me.
The money from the right issue.
Yes.
They said they'll use it to redeem the debenture.
Is it all the debenture?
Okay, 60%.
Is it all the debenture you want to redeem?
They said 60%.
So
Okay.
if I want to redeem 60% of the debenture, it means I need 60% of what? I need to have money that is equal to 60% of what? 90. 60% of 90 is what?
Okay.
54. So I must have 54 million naira, Abi, before I can redeem 60% of 90.
Okay.
Do you understand?
Yes, sir.
Therefore, the right issue I want to make, I must realize 54 million from it.
Okay.
You understand?
Yes,
Because
sir.
it is the money I get from the right issue that I will use to pay this 54 million.
Yes.
So the right issue must give me 54 million. So you will simply divide that 54 million by the number of the right issue. That will give you this 1.8.
The number of the right issue is 30
Yes, now.
million. Okay.
30.1.8 should give you what? 54. Do you understand?
Yes, sir.
So that's how we get it. That's how we get it. Now, what I will now do is, I will have to look at the market value of my share after the right issue. Okay? And the number of shares after the right issue. I will divide the market value after the right issue with the what? Number of shares after the right issue. Look at what I'm going to do. Now, I have 270 million existing shares. Value at what? What is the value? Let's look at the question. It's value at 5.2, Abi, if I'm not mistaken. Yes, it's value at 5.2. The existing shares are valued at 5.2 each. So 270 at 5.2. 270 at 5.2. We have 270 times 5.2. That is what? 1485. Sorry, 1.5.2 times 270. That is 1404. I think we have computed something similar before, Abi. So this gives me 1404 million. 1404 million. Now, what about the share we are issuing? We are issuing 30 million share. At what price? 30 million right issue. Right issue shares. Value at what? Value at 1.8. Can you see that? Value at 1.8. That is what gave us 54, Abi. That gave us 54. So after the right issue, what will be the total market value of my share? After the right issue, the total market value of my share. The total market value of my share is 1404 plus 54. 1404 plus 54. That's 1458. 1458. 1458 million. Abi? 1458 million. 1458 million. Now, what now happened to the what? The number of shares income after the right issue. We have computed it before. I just want to put the figure there. So after the right issue, our number of shares becomes what? Becomes 300. Can you see that? 300 shares, 300 million shares, number of shares after the right issue, and the total value of those shares is 1458 after the right issue. So what is the market price per share? The market price per share, the market price per share after the right issue is what we call theoretical ex-right price. So theoretical ex-right price, TERP, is equal to market value. Let me put the formula down. market value of shares after the right issue, all over number of shares after the right issue. Can you see that now? That's how you get it. So theoretical X right price is equal to, what's the market value of share after the right issue? 1,458 all over 300. That will give us what? That will give us 1,458 divided by 300 is giving me 4.86. 4.86 per share. 4.86 per share. What has happened? Before we make the right issue, what was the market price? 5.2, Abi? After the right issue, the market price has fallen to what? 4.86. Okay? It has fallen to 4.86. Now, the guy now says we should also compute what? Value of a right. Value of a right. Value of a right. What is the value of a right? Value of a right is equal to theoretical X right price minus right price. That's how you get the value of a right. Theoretical X right price minus right price. So value of a right is equal to, what is the theoretical X right price? 4.86 minus, what is the right price? Is 1.8. 1.8. So the value of a right is equal to what? Is equal to 4.86 minus 1.8 is 3.06. This is the value of a right. Okay, this is the value of a right. One right that the company gives you is valued at 3.06. Now, you may be asked to compute what? Value of a right per existing share. Value of a right per existing share is equal to value of a right all over number of shares per right. Okay? I put it that way so that you understand it. Per right. What am I saying here? I can say value of a right. Value of a right. Value of a right per existing share. The existing share will be equal to value of a right, which is 3.06 all over 9, because you must have 9 shares, Abi, before you can enjoy this right. This is the one share they gave you. As a result of the 9 share you are having, the value is 3.06. So, for you to get this value, you must have 9 shares. If you have 2 shares, you are going to have 3.06 times 2. If you have 27 shares, you are going to have 3.06 times 3. You understand? So, value of a right per existing share is value of a right all over the number of shares that is giving you that what? That value of a right. That is 3.6 over what? 3.06 divided by what? Divided by 9. And that is 0.34. That's all. That's the value of a right per existing share. This is value of a right in total. This is value of a right with respect to existing share. Are we fine? Any question on this? Any question? Okay, let us continue. Let's go back to the question. Are we done with vocabulary B? Let me see. And the value of a right. Now, the value of a right per existing share, the question did not ask you, I just added it so that in case you come across it, value of a right is what the question just asking. But if the question asks you value of a right per existing share, you have to add the last one I did. Now, we also discuss the director's view. Discuss the director's view that the right price records the share price. Discuss the director's view that the right price, that the right issue will cause the share price and the EPS to fall by an excessive amount to the detriment of shareholders. Your discussion should be supported by relevant calculation. So, let's go and compute first. Okay? Impact of what? Impact of the right issue, on market value, and what? And EPS. Okay, let me say on MPS instead of market value. Let me just put it as on MPS and EPS, on MPS and EPS. You want to see the impact of the right issue on MPS and on what? On EPS. Now let's see. On let's look at on what? On MPS. What is the impact on MPS? Now, before the right, look at it. Before the right, MPS before right issue. MPS before right issue was what? Was 5.2. I mean, MPS after right issue fell to what? Fell to, let's see, it fell to 4.86. It fell to 4.86. So what is the percentage fall? Percentage fall in MPS. Percentage fall in MPS is equal to 5.2 minus what? Minus 4.86 minus 4.86 all over what? All over 5.2 times 100. So that should give us 5.2 minus 4.86, okay, divided by 5.2 times 100, 6.5%. Can you see that? Our market value has fallen by what? By 6.5%. And then the directors of this company, they don't want the market value, okay? And even the what? The EPS to fall by what? More than 5%. But what has happened here? The market value has fallen by what? 6.5%. That's one. Then let's look at the impact on what? EPS. Let's look at the impact on EPS. Impact on EPS. Now, what is the EPS before the right issue? EPS before right issue. EPS before right issue. You know how to compute our EPS now? Okay, let me do this way. EPS before right issue. What is our current earnings? Let's go to the question. We are given our current earning in a portion of this question. What is the current earnings? This is our current earnings. Earnings as at 30th August was what? Was 164. I'm coming over. Okay, sorry. This retained earnings. This one is retained earnings. This one is retained earning. This is the earning we are dealing with, current earning. Okay, earnings at what? The end of the year. The retained earnings at that 31st what? 31st August is 64 point what? 64.8. Now look at it. We now have 64.8 because EPS is what? EPS is earnings over what? Over number of shares, over number of shares. Over number of shares. Earnings over number of shares. So that's what we have what? That's what we have as, we have it as 64.8, 64.8 all over. What's our number of shares before the right? 270. So what was our earnings per share before the right issue? 64.8 divided by 270. That is 0.24 before the right issue. This is our EPS. This is our EPS before the right issue. So let us now calculate EPS after what? After the right issue. After the right issue. What's our EPS? Let's conclude that. Now, you have to adjust this earnings here. This earnings here must be adjusted. How? Let's go then. We have our earnings to be what? 64.8. Our earnings is 64.8 million, Now, don't forget, this earnings here was when we are having a debt of what? When we are having a debt of, look at it, when we are having a debt of, where's the debt? 90. When we are having a debt of 90, look at the debt here. When we are having a debt of 90, we paid interest at 4% of 90. That was when we have these earnings. Okay? So the reverse is that since we have repaid part of the what? Part of the debt obligation, our interest is not going to be as high as we had it before. So what do? We need to look at what is the reduction in interest. So what interest are we saving as a sort of the debt we have redeemed? That will increase our earnings. Don't forget, that will increase our earnings. So savings on what? Savings on interest. Savings on interest. How do we compute the savings? Revised interest. Revised interest. Revised interest. Revised interest means after the right issue. Revised interest is 40% because the debt we have redeemed. We have redeemed what? We have redeemed 60%, Okay, let me do it this way. Let me do the current first. Let me do the current before the revise. Current interest is 90 times 0.04, which is 4% interest rate. So what do we have there? 90 times 0.04, 90 times 0.04. That is 3.6. 3.6 million was our interest currently before we redeem the debt. Now, what about the revised interest? Revised interest is when we redeemed what? Revised interest is when we now redeem the debt. We have redeemed 60% of this debt, We have redeemed 60%, so we are left with what? 40%. So 40% times, what's the value of the loan? times 90% times what? 0.04. This is the interest we'll be paying now. So let's get that. 0.4 times 0.04 times 90. Our interest is now 1.44. 1.44. You can see that our interest has reduced. So if we redeem the debt, we'll be saving it because our interest payment will reduce. So what is the savings? The savings is 3.6 minus 1.44, which is 2.16. So we are saving 2.16 as interest. We will have been paying 2.16. So because we are saving this, after we have redeemed the debt, our earnings will increase by what? By the amount we are saving. By the amount we are saving. So this is our revised what? Revised earnings. We are going to have our revised what? Revised earnings. So revised earnings is 64.8 plus 2.16. That is 66.96. 66.96. This is our revised earnings. This is our revised earnings. Now, if this is our revised earnings, what is our revised number of shares? Revised number of shares will be equal to 300. That is number of shares after the right issue, 300 million. Okay, so the EPS now, revised EPS will now be equal to EPS after the right issue, which is 66.96, all over number of shares after the right issue, which is 300. So what do we have as our EPS? 66.96 over 300. We have 0.22. Approximately 0.22. Now, what did we have before? Our earnings per share before was 0.24. Abi? Now it has reduced to what? It has reduced to 0.22. It has reduced to 0.22. What is the percentage fall? Percentage fall in EPS will be equal to 0.24, the previous EPS minus the current 0.22 all over 0.24. Sorry. All over what? 0.24. All over 0.24 times 100. That will give us what? That will give us 0.24 minus 0.22 divided by 0.24 times 100. 8.3%. The EPS has fallen by what? By 8.3%. And the directors do not wish to accept a fall of more than what? A fall of more than 5%. They don't want to accept a fall of more than what? 5%. But now it has fallen by what? 8.3%. So we cannot conclude. Look at it. The question is this. This is the requirement of the question we are solving. But we needed to support our conclusion by work calculation. Discuss the director's view that the right issue will cause the share price and the EPS to fall by excessive amount to the detriment of shareholders. So my conclusion here, or my comment will be that comment. The director's view that the right issue will cause the share price and the EPS to fall by an excessive amount to the detriment of shareholders. Is what? Is valid. is valid. Is valid. The right issue will cause the share price to fall by 6.5%, and the EPS will also fall by 8.3%. This is above the limit. This is above the limit of 5% acceptable by the directors. See, you can just put see detailed computation. See detailed computation above. See detailed computation above. So this is the comment you need to make with respect to that question. Any question on this, please, before we continue? Any question? Oh, yeah. Waiting for you people. Any question? Any question, please? Are you people not with me again?
We are here, sir.
Okay, any question?
The problem with these questions, like I said before, is understanding. It's understanding what they are asking.
But you understand this or not?
Yeah, because now you have explained it, but
the problem with every question, not only this question, is understanding.
Yes, that's what I'm trying to say. The problem with all these ICANN questions is understanding,
If there's no okay. So it is applicable to all exams, not only this question. So I will advise that you go over it again, like I've been saying, to ensure that you understand what we have done. The principle is quite simple, honestly speaking. The principle is quite simple. If you can sit down and you go over it again. Okay? Sit under the AC, get a very chill wine, and study it. You see that it will enter.
Okay, it is well, sir.
So let's go to the next theory. I'm not solving all this question. I'm not solving all these ones. That's the two I'm going to solve for you. Static trade-off. Static trade. I want us to finish my character structure today, so that we know that on Monday, which is tomorrow, tomorrow is Monday. On Monday, we should be going to investment appraiser. So, static trade-off.
Excuse me, sir.
Argue.
Excuse
ma'am.
me, sir.
Yes, ma'am.
Okay, these ones that you're not going to solve, how can we get their answers?
I will solve answer to you.
Okay, sir.
I will solve them and send to you.
Okay, sir. You need to understand.
You said?
Okay, sir.
No. The reason why I said I don't just want to bother you with those questions because they are not questions that will likely come out in the exam. You understand?
Okay.
I just because we have a lot to do than to be wasting time on questions that are not critical. You understand?
Okay, sir.
That's why I don't want to solve it. If it is something we must know, be rest assured that I will never skip it. You understand? So,
Yes, sir.
sorry, 1 minute. This man. Okay. Now, static trade-off theory. That's another theory of capital structure. However, this one is not having calculation at all. It's just explanation. Now, the static trade-off theory argues that for each company, there is an optimal capital structure with an optimal level of gearing. Don't forget that in traditional theory, this static trade-off is in line with what? With the traditional theory, for instance, that there is optimum capital structure. There is a level at which you can combine equity and debt, that if you go beyond that level, there will be issue. So the static trade-off recognizes that what? That particular approach to capital structure, that there is optimum level at which you can combine equity and debt. You now say that, that there is a trade-off. There is a trade-off between benefit of taking more debt and the cost of higher indebtedness. What are we saying here? When you are taking up new debt, you are taking up debt. You know, we said initially that it has advantages, because it will be reducing your tax. You'll be saving on tax. You'll be saving on tax. Now, static trade-off is now saying that there is a trade-off between the benefit you are going to get on what? On debt, and the cost that is associated with higher gearing. So, if you are geared, you might be losing that tax advantage. So, it means that you have to balance it up. Don't be excessively geared and don't be lowly geared. There should be a trade-off. There is a trade-off. So, when you are too geared, there is cost. When you are not geared, there is what? There is benefit you are losing. There is also a cost. So that is what static trade-off is telling us about. That there is a trade-off between the benefit of taking up more debt and higher what? Cost of higher indebtedness. And what is this trade-off? One, the benefit of taking on debt rather than equity are mainly in the tax relief that is obtained on debt interest. Can you see that? Modigliani and Miller have argued that although the cost of what? The cost of equity rises as gearing increases, the tax relief on debt means that the company with the average cost of capital falls as gearing what? Increases. That is a Miller and Modigliani assumption, right? So if you take more debt, the main advantage is the tax you are saving on that interest payment. And of course, Miller and Modigliani have argued it out that as you are taking more debt, your what? Your gearing should be reduced. Sorry, your WACC should be reducing, right? That is the benefit of debt as identified by static trade-off theory. Now, two, the marginal cost of extra debt are related to the what? Greater risk for financial distress. That is the cost of yield. So if you are the gluten one, okay, you want to use debt because Miller and Modigliani from somewhere has told you that when you take up more debt, your work will be reducing. Now, because of that, you are now piling up debt. You are now piling up debt. Then you are incurring some cost. What is that cost? The cost of high indebtedness. The cost of high indebtedness is associated with financial distress. What is the financial distress? The financial distress here means that the financial distress here means that the company may be what? The company may be forced to liquidate if the company cannot meet up with what? With the payment of okay. So financial distress means when a company is not able to make sufficient profit. Sorry, Jerry. So I said the cause of what? High indebtedness is where indebtedness, high indebtedness can throw a company to financial distress. If the company is not able to make sufficient profit to pay the obligations due to debt holders, you are not able to meet up with what? Payment of interest. And of course, when the debt falls due for a maturity, you cannot meet up with what? You are not able to meet up with what? With the redemption of that debt. That's the cost we are facing. That's the reason why static trade-off says that there is trade-off between what benefit on debt and cost of higher indebtedness. It has told you the benefit of debt, and it has told you the what? The cost of high indebtedness. So it now says that the optimum capital structure is obtained where the marginal benefit of taking up additional debt is equal to the marginal cost of higher indebtedness. Just like what we have what profit maximizing output and price, where they call the economy will tell you that marginal revenue is equal to marginal cost. I mean, marginal revenue is equal to marginal cost. That is where your profit is maximized. The same thing we are saying here. The point where we're going to have maximum benefit on debt is that point where the marginal cost of higher indebtedness is equal to the marginal benefit of debt. That is the static trade-off approach to capital structure. Okay? That is the static trade-off approach to what? To capital structure. So, in summary, these are the summary. Companies have an optimal level of gearing. In choosing the method of financing for a new investment, they will try to maintain and achieve what? Ultimate gearing level. The ultimate gearing level is what? Is higher for company with what? High profit than company with what? Low profit. If your company is big, you are making sufficient profit, you can afford to take up more debt because your margin of safety is high. But a company with lower profitability will dare not take excessive amount of debt, because it means if your profitability is low, you will not get sufficient money to pay a higher amount of interest. You understand? That's why the question says the gearing for what? A more profitable company is higher than a company that is having a lower profitability. So this means that there is a positive correlation between profitability and gearing level. This is the whole essence of what? The whole theory of static trade-off. Then the last one, but not the least, is what? Is pecking order theory. Pecking order theory. Now, pecking order theory take a very different view of capital structure. Pecking order theory's view is quite different from all other theories that we have been discussing. What does it pecking order theory's proponent say? They said that that both the traditional theory, Miller and Modigliani, and even the static trade-off, that they are not right in their word, in their assumption that a company has a higher or optimum gearing. They said no, that a company, the management of a company will not have to start studying capital structure. That at what point can I combine equity and debt in my capital? They said that is a waste of time. That what managers actually do is that the first thing they identify is when they want to finance a project, is that they identify the they identify the source of finance that is the cheapest. They don't want to know their journey, whether they are geared or they are not geared. The first thing they look at, this project we want to finance, which source of finance is the cheapest for us to finance that project? So they will choose that word. If that source of finance is there, good, they choose there. If it is equity, they choose equity. So they said that is what companies do. So they now make what? They rank the sources of finance in this order. They said if a company want to finance an operation or an investment, the first thing they think of is what? Is retained earnings. So if I want to undertake an investment, before I will take on any capital, the first thing I will think of is what? Is retained earning. Why? Because retained earning does not have any cost. Retained earning is my accumulated profit. You understand? So if I use my accumulated profit, I'm not paying anybody for using it. Can you see that? Now, they now said if retained earning is not available, there is no retained earning, the company will now think of what? Issuing debt. That is second. Because debt is cheaper than equity. So the first is retained earning. If retained earning is not available or retained earning is not sufficient to undertake that investment, we can now think of what? Debt. Because debt is cheaper than equity. If debt is not available or it is not sufficient, then we now think of equity. In essence, the last capital that a company will think of is what? Is equity. The first is retained earning, the second in ranking is debt, and the what? And the last is equity. So the pecking order theory said that this is the what? Hierarchy that a company will follow when evaluate or when what? When sourcing for capital to finance a project, not to try and be wasting their time on studying the capital structure. That it is a waste of time trying to study the capital structure optimum because it does not exist. Now, the reason for pecking order theory preference for source of finance can be explained by one, where I have said it, let's just go through it. Using retained earnings is what? Is convenient. If a company wants to finance a new investment with equity, it is much simpler and cheaper to use retained earnings than to arrange a new share issue. Retained earnings are also much more convenient than new borrowing. If you want to borrow, you have to follow procedure, bring this collateral there and there. But retained earnings is readily available and it is cheaper. It is convenient to use. That is one of their what? Justifications. Two, if a company cannot finance an investment with retained earnings, it will prefer new borrowing to a new equity share because borrowing is cheaper. It is cheaper to arrange loan than to issue new shares. The cost of debt is also less because of the tax relief on interest payment. So these are the reasons for pecking order theory preference for what? Sources of finance. Sorry. So in summary, pecking order theory states that companies do not have an optimal level of gearing. There is no optimum level of gearing. Two, in choosing the method of financing for a new investment, they have an order of preference. Retained earnings, followed by new debt capital, followed by an issue of new shares. And lastly, Companies with high profit can rely on retained profit as a source of finance more than companies with low profit. If you are operating in an industry and you are not making a profit, so you are not making sufficient profit, you are not making enough profit, of course, you will not have what? You will not have enough retained. As a result, you will not be able to what? To rely on retained because you don't have much. Except when you are operating profitably, that you will have accumulated retained. Then you cannot say, oh, you want to finance your investment from retained. But if your profitability is low, of course, you cannot rely on retained to finance your what? To finance your project. This means that there is negative correlation between profitability and gearing. Okay? I believe you understand this statement now. This means that there is a negative correlation between profitability and gearing. If you are not profitable, it means you'll be taking debt, Abby. Can I say that? It's negative. If you are not profitable, you'll be taking debt. Other theory like a static trade-off says that if you are not profitable, it means there is no what? There is not much earning. You are not making enough profit. So you should not be taking debt because you might not be able to meet up with what? Interest obligation. But taking other theory is saying that if, okay, you are not having profit, enough profit, where will you get retained to finance your project? You have to go and borrow. So that is what? Negative correlation. Normally, if you are not profitable, you should not take debt because you may not be able to pay interest. But taking other is saying that if you are not making profit, where will you get retained to finance your project? And we know that debt is cheaper than equity. So you have to go and borrow. So your gearing will increase. So there is negative what? Correlation between profitability and gearing level. Okay? These are justifications. I've explained this one earlier. I've explained all this. We just go through it and we are done. Retained is cheaper. There are no issue costs attached to retained. Investor prefers safe security. All those ones. These are the reasons why we have preference for the order of what? Of pecking order theory. Now, what are the limitations? What are the limitations of a pecking order theory? What are the limitations? One, pecking order theory fails to take into account taxation, financial distress, agency costs, okay, or how the investment opportunities that are available may influence the choice of finance. Sometimes, before you take finance, you have to look at the link between the project you want to undertake and the what? And the finance you want to take. You don't just use any other source of finance to finance your project. You must know the relationship between that finance and what? And the project you want to what? You want to undertake. So pecking order theory is not looking at this. Do you understand? It's not looking at that. And it's not also looking at financial distress. It just know that, oh, if you want to finance an operation, there's no retained, and you have access to loan, go and borrow instead of equity. You understand? Go and borrow instead of equity. What about if you are jailed before? So pecking order theory encourages you to what? To pile up debt excessively. Okay? So it's not taking account of what? Financial distress that can what? That can come up as a sort of higher level of gearing. B, pecking order theory is an explanation of what companies actually do rather than what they should do. In actual sense, this is what companies do. Pecking order theory is what no company studies capital structure theory, optimal capital. What they do is what pecking order theory has told you here. That's what companies do. But in natural sense, that is not what they should do. You understand? That is not what they should do. That's why I say pecking order theory is an explanation of what companies actually do rather than what they should do. What they should do is that they should what? Evaluate the what? Impact of the finance on their what? Cost of capital, all those things, on their gearing. But they don't do that. They follow pecking order theory. That pecking order theory simply explains what companies do in real life but it is not an explanation of what they are supposed to do. That's another limitation. And C, studies suggest that the business that are most likely to follow pecking order theory are those that are operating profitably in the market, where growth prospects are poor. There will therefore be limited opportunity to invest funds. Hence, the business will be content to rely on retained earnings for the limited resources that they need. This is what I say. Pecking order theory is applicable to companies that operate what? Mostly in an industry where profitability is low. I've explained that earlier. Where profitability is low, then, and there is no what? Much growth prospect, then to get finance may be difficult. So the small retainer you are having, you might be the one you have to what? You have to rely upon. And lastly, I think that's all. That's all. So what is the practical factor? That's the last we are going to discuss today. In actual sense, what are the factors that determine capital structure? Okay, we have practical factors that determine the capital structure we are going to adopt. What are those factors? Number one, restriction in loan agreement. You have taken loan from company A. Okay, you have taken loan from, let me say, bank A. You have taken loan from bank A. And in that loan agreement, bank A has stated that you cannot take additional debt until you repay that debt. It's a loan covenant. It's a loan covenant. So even though you have opportunity to borrow another loan, you may not be able to borrow it because you already have a covenant. You have to honor the covenant. You understand? So in that case, even where you have opportunity to borrow, you might not be able to borrow. So that determines your capital structure. Okay? That's a factor that determines your capital structure. Number two, business risk. A business with what? A high business risk is expected to be operating within a lower level of gearing. A high business risk means that the business is unstable and could suffer a considerable fluctuation in its profit. Such company is not ideal for debt financing. All these are self-explanatory. If you are not making sufficient profit, okay, then it is better you keep your gearing to the barest minimum. Keep your gearing to the barest minimum, because any attempt to use debt excessively will mean that you are putting yourself in financial distress, because you will not be able to meet up with what? With the obligation. What about asset structure? Providers of debt capital will prefer lending to business with more of tangible assets than what? A company with more of intangible assets. If you are a finance provider, you give loan to companies, and one company comes to you, and the company is having tangible assets, building, plant and machinery, motor vehicle, lorries of 80 million, but intangible assets of what? Of 20 million. And another one comes to you with intangible assets of 80 million, but tangible assets of 20 million. Who will you give your finance to? You give your finance to a company that is having a higher amount of what? Tangible assets. Because you know that at liquidation, you can sell tangible assets to get your money back. But intangible assets cannot be sold. Intangible assets are like goodwill. You cannot sell goodwill. So it is better to provide finance to a company that is having what? That is having more of tangible assets than a company that is having more of intangible assets. These are the, okay, we still have two more. Management attitude. This one is just attitude of the management. Okay, where they find, they follow their wish out of what? Don't forget we discussed agency conflict in our opening chapter. So management attitude can lead to what? Even where they are not supposed to take debt, they will take debt. That is their attitude. Management attitude can also influence capital structure. So what about taxes? Because tax is deductible on expenses, then a company will what? Will try to use more of debt than equity in order to get that tax advantage. These are the practical factors that determines capital structure of a company. Any question before we call it a day? Any question here before we call it a day? This brings us to the end of capital structure theory. So in our next class, we are going to capital investment project. That is chapter 5. That is chapter 5. Capital investment decision. Capital investment decision. That is our next topic. Any question, please, in 1 minute? Are we all fine? Are we all fine? Okay, if that is the case, we call it a day. We are going to meet tomorrow by God's grace. And tomorrow class, I wouldn't know whether we will be available for, will I be back by then? I'm looking at whether we can start the class by 4:30 and end it at 7. Is it possible? Please respond. Is it possible to start by 4:30? Mrs. Angela, you want to talk?
Other people.
Eh?
So for me, it's fine. I don't know about that.
Tomorrow is
It's
public
fine.
holiday.
Mrs. Sue and Mrs. Angela, is it fine?
It's okay, sir. It's okay, sir.
Okay, so our class for tomorrow will be from 4:30. Don't forget, I want us to move faster. Okay? And I want to tell you that what we are doing here, even in my physical class, we are still in investment appraisal. So what we are covering here is not sufficient, substantially less than what we are covering in the physical class, honestly speaking. But I want us to be creating more time so that we can what? We can cover the main part of the syllabus first. That's my aim. We cover the main part of the syllabus first, and the remaining part, we know what? We now start doing those ones like fudge. I mean, just be doing it small until the exam comes. So we meet tomorrow by God's grace, 4:30, and we continue our discussion from there. Do have a lovely night rest ahead.
Okay, sir. This Sunday class is interesting. If it's possible, we'll continue.
It's not going to be always so. That's just the honest thing. It's because someone is taking my class today. That's why I fixed that class. You understand? But
Okay,
anytime
sir.
I will be available, I will let you know ahead of time. Okay?
Okay, sir.
Thank you.
Thank you,
Bye-bye.
sir.